Now, the latest bond auction by Nigeria's Debt Management Office was significantly undersubscribed as investors demanded higher yields, and in the meantime, Nigeria has kicked off a roadshow for its proposed $1 billion Eurobond. To discuss the latest news around Nigeria's fixed income market is Ege Apata, Head Capital Markets at UBA Capital. Ege, thank you so much for joining us. But a very quick view from you on the development we're seeing in the primary market for equities before we move on to the fixed income side. We're only hearing about rights issue. What I'm hearing now is that Oando had a successful rights issue. Sterling Bank is in the market right now for 12.5 billion naira. It would be interesting to get your thoughts on why we're not seeing any IPOs.
Well, good afternoon, Wale. Thanks for having me on the show. In terms of why a lot of companies, particularly listed companies, are doing rights issues, it's quite simple. Most of the shareholders think their companies are grossly underpriced, but they have a situation where they need to raise some new equity. And rather than opening it up to external shareholders to come in at what they see as depressed prices, they'll rather do a transaction with existing shareholders where technically if they all take up their rights, there'll be no dilution.
Right.
So effectively the company raises money, the shareholders get what they see as a discount price, and they retain their current shareholding structure. All
right. Okay, let's move on to the fixed income market very quickly. A bond issue not very successful, massively undersubscribed. The government was looking to raise over 80 billion naira. They only raised about 21 billion naira. So your thoughts on what this means for future bond auctions going forward?
Well, I think it was quite interesting that you had such a low level of such a small amount sold, only 21 out of 85 billion. If we go back to October 2011, where there was a spike in rates, the October DMO auction had the 7-year bond issued at 18%. In September, that same bond was issued at 11.49. And what it showed then was that the DMO was just automatically issuing at every auction. In this case, they decided that the rates were too high, and when the rates were too high, they will not issue. So it does send a signal that the government will simply not issue at any price. However, it does create a challenge. If you have subsequent months where people at the auction are still bidding significantly higher rates than the DMO is ready to issue at, what happens? Bear in mind that the prices at that auction were lower than what was trading in the secondary market. So pretty much most people who bought at that auction probably are already underwater as we speak.
Right. And of course, they've announced plans for the third quarter. So the big question is, how are they likely to play this? We know that there are some maturing bonds, and of course, that's something that we'll have to think about in terms of when to issue and, of course, what is maturing. But your thoughts about how they're likely to play this going forward? Because many will argue that this high interest rate environment is here to stay for a while.
Well, I mean, it's debatable whether it's here to stay for a while. But if you look at maturities up till the end of June this year, you have about 672 billion.
Right.
Whereas as of now, only 627 billion has been issued. So 45 billion more maturities than issued.
Right.
So clearly, the government debt stock is actually going down with that.
Yeah.
You don't have much maturities in Q3. You have maybe about 240 billion or 230 billion in Q4.
Right.
So clearly, I mean, if the government was able to ramp up their issuance, yes, you'll start to have net addition to the bond positions or outstanding by the DMO.
Right.
But the challenge is that if you have subsequent months, like June, you could get to a point where the DMO cannot even raise as much as it wants, and it might be forced to issue at higher rates if these rates persist for a long time.
Well, they certainly can get lower rates in the international market, and now we heard that the roadshow has kicked off for the $1 billion Eurobond issue. So maybe that's part of the strategy. Let's get your sense of at what rate you think they are likely to issue at.
Well, I mean, in terms of the international markets, there's been some turmoil driven by comments from the Federal Reserve about what they're going to do going forward. So right now, I mean, I think the Nigerian Eurobond is trading about 5.8% yield, which is substantially higher than about 4% level that it was a few months ago. They're doing a 1 billion issue. The outstanding bond is only 500 million. Probably have to be around 6% to get it oversubscribed. But in terms of whether it's cheaper to go international or local, I mean, it's foreign currency. If you have a devaluation, it might work out to be actually cheaper to borrow from local markets. But clearly, as long as the exchange rate is stable, you're getting money at 6% compared to 14, 13% locally. It seems like a good deal.
Right, so it's a bet on the stability of the exchange rate for that to make sense for the government. But of course, well, you're going to make a point?
Yes, I mean, obviously, but the government does earn money in foreign exchange from oil sales, so they might not be as worried. But when you look at the number of banks who are also out there in the market, there are 2 banks out there for a bit over $1 billion as we speak. Again, they will have to pay increasing significantly more than the federal government, because the existing bank bonds, Euro bonds, have traded, their yields have gone up substantially in the past few months.
Right.
Again, they tend not to take on currency risk because they raise money in dollars and they deploy the loans in dollars.
Right. It's interesting
but
to
in
see
the case of the Nigerian
how
government,
turmoil